Well, welcome everybody to our Covenant Wealth Strategies Stone Barn Speaker Series. This is the first virtual Stone Barn Speaker Series. I want to express my appreciation to Michelle and Randy and our team here at Covenant Wealth Strategies for doing a great job getting us ready for this. And we're delighted to have so many of our clients and friends on board with us today. We were discussing how we wanted to do this program and the things that have been highlights of our in-person Stone Barn Speaker Series. And I think about the only thing that we weren't able to figure out was how to do the virtual hors d'oeuvres. So you'll have to make provision for that there yourselves. But for right now, we are just glad to have you with us. Thank you for spending part of your day with us. We're also delighted because we have a number of clients who are not able to be with us in person because they are in various areas of the country and even the world. And so we're excited that we have several folks who are able to join us today that are not usually able to join us. So welcome to you as well. We are pleased that you are with us. So we are very excited, and quite frankly, feel like we are getting away with something here to have Ryan Detrick with us today. Ryan is a vice president and senior market strategist with LPL, and he's also a member of the Financial Research Tactical Asset Allocation Committee at LPL, responsible for directly impacting the portfolio decision-making process on various models that LPL makes available to advisors. He's also a member of the LPL Market Insights team, and in that role develops and articulates equity and general market strategies. He is a frequent presenter to clients and industry peers and the national media on emerging and developing market trends. In fact, if you watch CNBC Squawk in the morning, you'll often see Ryan with his smiling face there. So here you get to see him in your own private little show. So prior to joining LPL, Ryan was building his market knowledge and solid analytical skills as a senior portfolio manager at Haberer Registered Investment Advisor, and there he managed sector, asset allocation, and strategy for high net worth client portfolios. Prior to that in his career, he spent over a decade at Schaefer's Investment Research, and his research and market analysis used both technical and fundamental, as well as sentiment methodologies. And Ryan, you'll have to talk to me a little bit about sentiment. It's not sentimental, not like technical and fundamental and sentimental, right. But sentiment. And with a focus on market expectations and advanced options strategies. During his tenure there, he was the company's primary spokesperson, was widely quoted in national media outlets, including appearances on business television programs, including CNBC, as well as Bloomberg TV and Fox Business. Ryan earned his CMT, Chartered Market Technician designation, along with a BS in Finance from Xavier University and an MBA from Miami University. He also holds his FINRA Series 7 and Series 66 licenses through LPL. And so that's kind of the formal intro of Ryan. And as I make introductions to people, I always like to ask, tell me something personal. Tell me something that's not in your bio. And so I learned from Ryan that growing up and living in Cincinnati, in fact, he only moved from Cincinnati to Charlotte, North Carolina 4 years ago to join LPL, and we're very, very glad that he made that decision to do so. But growing up in Cincinnati, it's ingrained in him to cheer for the Bengals, and so it's been kind of a hard life in that way. But Ryan and his wife Emily and their 3 children live in Charlotte, North Carolina, and he spends a lot of his time coaching his children's sports teams and driving around their Charlotte community in a golf cart. And I asked him if they had golf carts in Cincinnati, and he said, no, not really. But maybe if they got those for the Bengals, maybe that would help. I don't know. I have one question for you, Ryan, before we get started.
Yeah.
And I know very, very little about sports. And in fact, when we were talking about it here previously, I mispronounced his name to show you how little I know about sports. But I suggested that we should ask you whether this young kid by the name of Joe Burrows, and so I was immediately corrected and said it was Joe Burrow, but whether or not he was going to make any difference for the Bengals this year. So I thought I'd start you off with a non-financial question.
Well, that might be the toughest question I get asked all day. There's an old saying, hope is not a strategy, but as a lifelong Bengal fan and all the agony that's brought with it, I'll just say we hope that Joe Burrow can bring some smiling faces back to Cincinnati. He is an Ohio boy, grew up in, let's see, I guess the southeastern part of the state, so he's back home in Ohio. So, we watched him win a championship at LSU just a few months ago. He looked pretty special, so hope's not a strategy, but we're hoping he brings that magic arm to Cincinnati.
Well, certainly he'll bring some wins to Cincinnati, so you should have some things to cheer about. Yes.
Low bar, but yes. All righty. Well, thank you for the intro there, Ward. Thank you, Randy and Michelle, for having me. The whole team. I'm honored and delighted to be here. I didn't realize this is the first virtual meeting. So far we're off without a hitch. This is good. It's neat where we've all learned how to adapt. So we're going to get into where we see the market and the economy and all those things. But just the idea that I am in the office right now. So technically LPL's office is in a little town called Fort Mill, South Carolina. That is right on the border. Charlotte is right on the border. So we're just right across the way there. A lot of big companies have moved to South Carolina, tax breaks and things like that. And like you said, Ward, I moved, it's like 4 years ago last week. 4 years ago last week, we got the moving trucks and moved down here. And I joke, I never in 1,000 years would have thought I'd live in South Carolina. Again, we're right next to Charlotte. It's all right there. But 1,000 years I live in South Carolina. But sure enough, I do. I love it. It's met a lot of good friends. Now, as an Ohio boy, we do have Clemson, and maybe there's some Clemson fans on here, but I'm an Ohio State fan for football. We're not going to talk all sports, I swear, but a lot of Clemson fans, they're pretty good, so they let you know about it. But it's all fun and good fun. So again, I've been with LPL for 4 years. Market strategies, get through lots of fun stuff. You mentioned the TV media stuff. It's kind of funny with, everybody working from home for the most part. So maybe you're sleeping in a little bit more. I think I'm sleeping in a little bit more, and I actually was on Bloomberg Radio this morning at 6:15. So I got up like at 5:40 probably to kind of prepare and get ready. I haven't been up that early in a long time. So guys, it's near the end of the day. I get my energy going, but I'll tell you, if I start dragging or start yawning, I'm not going to. But if I do, because I got up a little bit earlier than I'm used to doing with getting to work from home and work kind of remotely a lot. But again, really excited to be here. Thank you so much for the opportunity. So let's go to there's the email questions. Maybe leave it there for a second or so. If you have some questions, feel free. We're going to have some Q&A here at the end, and we can talk a little bit about markets. But I do these fairly frequently, and I kind of get to talk to people. So I'm going to do my best to answer what I know are a lot of the questions that I get continually, but still we'll have some fun with that. So let's go to the next slide if we could. It's good to be prepared. Just leave it here for a minute. So the idea that, if I would have done this, what is this, June? Isn't it crazy? June 9th, first off. But we're in June. And if I would have done this with you guys 7 months ago, and we would have done a 2020 outlook, I would have said this: LPL Research does not see a recession. We see a continuation of this 11, soon to be 12-year economic cycle of growth. Earnings have been up maybe 10%. Stocks could have gained 10 or 15%. That's what I would have told you. Reality of the fact is that's, some of those things didn't happen. COVID-19 happened, and yes, we did not see the fastest bear market in history. We did not see the most violent recession we've seen since the Great Depression, and in a lot of ways, the most violent recession we've ever seen. Flip it around, now we've just as much gone all the way up. I don't think the NASDAQ was up today, but NASDAQ made a new all-time high just yesterday, okay? We just had the best 50-day rally in the history of the stock market. Now, as I like to do, and you'll get the vibe as I talk, I like to look at past history to show maybe a potential path for the future. And yesterday, the NBER, those are the people who say we're in a recession or not. National Bureau Economic Research. They said, yes, we're officially in a recession. Any of you on the phone are aware we're in a recession. 20 million people lost their jobs in April. We're in a recession. But the idea that, they finally came out and said it, it makes sense. But it's just, it's just unbelievable when you consider the fact that the S&P is 5% from an all-time high. I guess we're down a little bit today, maybe a little more, but as of yesterday at least. And then yesterday, the NASDAQ made a new all-time high. I was just looking, when in the world did the NASDAQ make a new all-time high when the economy is in a recession? I mean, that doesn't make much sense. And we're going to talk about how things aren't making a lot of sense here. The only time that's ever happened, November of 1982, the economy was in a recession, yet the NASDAQ made a new all-time high. That recession ended that very next month. And if you think back to market history, late 1982 was the kickoff to a really good 18-year bull market. Now, we're not saying this time's the same, but I am saying there's, that's unique. The stock market leads the economy. Anything I talk about here, it's the idea that the stock market leads the economy. And on the way down, think about February and March. The headlines got terrible in our country in April. But February and March, oil was crashing, stocks are crashing, bond market was freaking out. They were saying trouble is coming. And sure enough, in April, that's when the data just got terrible and headlines were horrible. Yet stocks had one of their best months ever, the month of April. And right now, we think it's the exact opposite, right? Where stocks are saying, hey, guys, listen, there could be better times ahead. Just last Friday, 2.5 million jobs were made last month, the month of, I guess that'd be May. Now, much better than most people expected. I get it. We've still lost 20 million jobs the 2 months before. This is a long way to go, and it might take years to make up those gains, or not those gains, to make up those jobs back. But it's just, it is important. I think the stock market could be telling us with new highs in the NASDAQ. When NASDAQ leads, that's usually a good thing, right? A little bit more technology in there. That could be better times ahead. But here's why it's good to be prepared. Go ahead and show the next slide. This is a live image of my bathroom right there. You got to be prepared in a COVID-19 world. So there's my bathroom. We do actually use Amazon. They send us toilet paper every month. And for 3 months in a row, there's no toilet paper. But you know what happened this month? The toilet paper came. So hopefully it's another sign that, this economy isn't normal by any means, but hopefully there's some more normalcy coming. It might be a small little inkling of that. But let's go to the next slide here. See what we have. Oh, here we go. How do you feel? These are just a sprinkling of some of the recent magazine covers and newspaper covers we've seen in our country over the past 2 months. Now, it's scientific. The colors red and black bring out a certain amount of fear, right? They cause fear in your brain. And that's why when you see red and black magazine covers, that's honestly what they're trying to do, get your attention, bring some fear. You see Time, Barron's and Time, obviously very, very bearish articles. I mean, we've seen, I sound like a broken record here, record drops in manufacturing, industrial production, consumer spending, retail sales, consumer confidence, you pick it, it's happened, okay? The last 2 months, we've just had unbelievable drops, and that's why those magazine covers look like that. And the New York Times one on the right, I mean, that's going to go down in history. That big red bar that goes the whole length of the front page of the New York Times, that's the 20 million jobs that were lost in the month of April. Just to put it in perspective, those little tiny blips of red up at the top, just how massive this was. And you think about the economy for a second. We had a 10.5-year cycle of growth, but how do you stop your car? How do you stop your car? Pump the brakes, slam on the brakes, hit a tree. The reality of the fact, guys, is our economy hit a tree. And that's what we're trying to come up from and improve from. And the good news is we've started to see a little bit better economic data. I mean, things like OpenTable. OpenTable, if you don't know, is the app on your phone. You can order reservations at a restaurant. If you look at the 25 states that have started to open up, OpenTable the reservations are really soaring the last couple of weeks. So there's things like that, electricity use, public transit, some of these real-time high frequency data points that we've been looking at for a while are really starting to come back. Now, I get it. Literally no one was on OpenTable in April making reservations in the second half of March. So there's only one way to go, and that fortunately is up. So a long way to go to get to the top. But the market, in our opinion, is forward-looking, and it is saying there could be definitely better times ahead when we see the high-frequency data really improving. Those are signs, again, that I'm going to talk about the recession that we're in, but we think this is going to be a very, very short recession. Let's go to the next slide. What do we have? So I love this quote by Carl Richards. Risk is what is left over after we've thought of everything else. That's COVID-19. I mean, to be honest, we just slowed down the fourth quarter globally. January and February, the U.S. data and the data around the globe started to improve, start to accelerate again. Stock market, at least the S&P 500, made a new all-time high on February 19th. I mean, it feels like a lifetime ago. Then we had what? The fastest bear market in history. And this is what we're showing on the screen here. The Dow Jones just had a birthday. The Dow Jones started trading on May 26, 1896, 124 years ago. What we just saw was the fastest bear market in the history of the 124-month Dow Jones Industrial Average. And that just really puts it at home. You can see 1929, 1987, some of the spectacular crashes. Took only 19 trading days for the Dow to make a new high. Also, fastest 30% correction in history. You were to look at the S&P, very similar. Fastest bear market ever, fastest 30% correction ever. Just truly, truly phenomenal and devastating. I mean, honestly, devastating the wealth that was lost during the initial, total freezing, I guess I'll say, of the U.S. economy and the uncertainty that could cause. Let's go to the next slide. So the expansion is over. And this is a slide, again, we've been using for a while, but now it's official, okay? We were making the assumption, and it was a pretty safe assumption, that the economy peaked in February, recession started in March. Yesterday, that became official. So you can see on the screen there, the length of this expansion was 128 months old. That's over 10 years. The average expansion, as you can see there, is about 58 months. So we're just going to call that 5 years. So the average expansion is about 5 years. This one was twice as long. Was this the greatest expansion in history? Well, we would say no, and here's why. Check out GDP. GDP is gross domestic product. Simply put, how much your economy is growing. The economy grew 50% over those 10 years, or 10 plus years during that record cycle of growth. That's about average. I mean, let's see, 90% growth in GDP in the 60s, 72% in the late 70s. I mean, everything's late 70s. I think it's at least following history, like high inflation, and wasn't that great of a time. That was after a vicious recession, but good growth there. The 80s, 90s, you saw good growth. So we just went 10 years with the best year we could get, right about 3% GDP. And believe me, you could talk to 10 people and get 10 answers why we didn't really have much economic growth. For that 10 years, we had it, but it wasn't spectacular growth. I mean, I think a lot of it was the Fed, right? We're going to talk about the Fed here, but the Fed kept interest rates low and expanded the balance sheet and did a lot to help stocks, which is good. Hopefully everyone on the line was happy with the 10-year bull market that we just had, and honestly, the massive recovery we've just had from an equity point of view. But did what the Fed did really help the economy? Probably not. I mean, honestly, the Fed, they can try to help, but you need that from the fiscal side of things, whether it be deregulation, tax reform, infrastructure. Some of those government spending maybe can help a little bit. Some of those levers can potentially help the economy. And, that's not really what we saw for 10 years. And that's partially one of the reasons we think we had such a long period of growth. But the funny thing about it, one of the reasons we thought that cycle could keep going, and again, it's over because we had a recession, or we're in a recession, but the fact that we weren't seeing excesses, right? We say at LPL Research, economic cycles of growth die when there's excesses, too much spending, too much confidence, too much leverage, just too much fun, feeling too good. Nice, slow, and steady actually made us think it could keep going. Now, again, that's not the case, but those are some of the big picture things that we're seeing when we look at this. Now, the big question is the next thing. Okay, we're in a recession. What's it mean? How long is it going to be? No question about it, one of the most deepest, vicious recessions we've ever seen in history going on right now. But we also think, we've been on record since March saying this, that we think it's going to be one of the shortest recessions. Can you think about the economy? We didn't have the excesses that you usually see that lead to trouble. We stopped because the government, rightfully so, said stay inside, stay safe. We're willing to shut things down for near-term pain for long-term gain. Well, look at the recessions on the right there. There's one that says 6 months, and that was in the early 80s. Okay, we had a recession. There was someone named Paul Volcker, 6'7" Paul Volcker, tallest Fed chairperson ever. He actually hiked interest rates significantly in the early 80s to beat inflation, break inflation's back. He had the president's backing, he had Reagan's backing when he did it. And you think about it, that's not similar to now. I'm not comparing it to now, but that's somewhat similar where they had to have known. If you take short-term rates pretty low, up to 20%, you're probably going to cause a recession. And that recession did break inflation's back. So that short-term pain led to long-term gain of really good, really spectacular economic growth during the 80s and 90s. And that's a somewhat similar now where the government / Fed caused, I'm going to say, quote unquote, caused the recession, but for the right reasons. I want to be very clear. So maybe we can get, that was the shortest recession on record when the Fed caused it. Now this might be the even shorter recession on record as the government caused it, but now we're starting to open back up. Let's go to the next slide, please. So Ward, you said you don't do much with sports, but I like to use this example. This is basketball, okay? It's the NBA, where the shots are taken. 20 years ago, you can see some three-pointers and baseline and elbow shots. Look at the game today on the right. You shoot a three or you dunk it, okay? Times change, things change, people change. So the NBA game has changed. Why in the world did we just have the fastest bear market history with the fastest 30% correction history with record? Again, I don't have the slide in here. We have a website, lplresearch.com. If you like some of the things that I'm doing today, you can sign up and kind of see some of the things we're doing at LPL Research. But we just had the greatest 50-day rally in the history of the stock market, at least of the S&P 500. Okay, after the most vicious sell-off. What's going on? Why is there so much volatility? Why do we have the quickest bear market ever? We would say one of the potential reasons we're connected more than ever. Yes, we have a 100-year pandemic happening. I mean, that's the short answer why. But the fact that, like social media, it's a wonderful thing. But at the same time, it could be negative because when all the bad stuff was happening in March and April, what happened? The second someone got sick, the second someone tragically passes away, that was all over the news. It was all over social media. And then the market was just so volatile. So things do change. And the way we communicate has changed. And I've said this for years now. I like to use information, right? I use information to tell stories, to make my market opinions and investment opinions. But the reality of the fact is there is too much information out there. There is information overload, and you can get paralyzed by all the information that's out there. So you got to do your very best and it's hard to try to focus on what really, really matters, or you can get kind of in a coma and you can't even react to it. And I really think that's somewhat of what happened with the market, where we just saw some of the most volatile markets we've ever seen. I mean, last thing on this, the month of March was the most volatile month in the history, again, of the stock market. If you look at the average daily change, it was 5%. That could be either up or down, absolute value. Every day moved 5%. I mean, that's just, that is wildly more than any other month in the history of the stock market. And again, pat yourselves on the back to get out on the other side, and now we're flirting with new highs. I mean, that's just an amazing feat for a lot of us to sit through and make it to the other side. But it's been a wild one, but we think so much information is partially why that's happening. And the reality is it's probably not going away, right? There's only going to be more information, so we just have to be aware of that. Let's go to the next slide, please. Love Jack Bogle. He's a true legend in our industry. Started Vanguard. I love this quote. I spend half my time wondering why I have so much in stocks and half wondering why I have so little. That's 2020 to a T. Making new highs, you're down 34%. Now all of a sudden you're flirting with new highs again, or 5% away on the S&P. But it's just amazing. But we just had, this is really important to know, the best 20, so we had the best 20-day rally. I mentioned the best 50-day, but this is a slide we put together a while back. Look at what happens after the best 20-day rallies in history. 6 months later to 12 months later, really strong returns. The key point I think that I want to point out here is the moves that we've just seen over the past 50 trading days, give or take, are not hallmarks of bear markets. They're not hallmarks of the start of a bear market or the end of a bear market. They are the start of bull markets. Now, we're not calling this the brand new bull market, but what we are saying is history would suggest the strength we've seen is so broad, so much participation, such an amazing bounce, that history would say, this is very likely 6 to 12 months from now, we absolutely could have some continued gains. And as you can see on your screen there, the other times we've had bounces like this, those gains are sometimes really, really powerful. So it's important to remember that and pay attention to the past, in our opinion. Now, let's see what the next slide says. So thank you. We've been through a lot in our country and in our world. These are some of the worst crises we've ever seen back in 1907. The panic of 1907, the first banking run we ever saw, really was the opening the door for creating the Fed, which was created down here in Jekyll Island, just see, I think it's in Georgia. I think I know. I've been there. It's Jekyll Island's in Georgia. Anyway, if you ever get a chance to go down there, it's a neat little island. But that's where the Fed started in 1913. Anyway, so we've got all these terrible things that have happened in our country's history. Let's go to the next slide. And here's what the stock market's done after all of them. Pretty solid returns. The reality of the fact is we've been through some horrible times, and what we're all dealing with the past couple of months, no question, has been one of the worst in our lifetimes. There's no doubt about it. But from an investment's point of view, it's so very important that the stock market is a discounting mechanism. And when everyone gets so bearish and so worried that the economy is different, we have to separate from the economy. It's so very difficult, I'm fully aware. But that's priced in. And when the worst that people are worried about don't happen, you can get upside surprises. And that's exactly what we're seeing so far this year in 2020 in our view. But just remember that stocks are historically quite resilient in the face of crises. And that, the sad truth is we're going to have more crises. Let's hope we don't have the word hope. Hope's not a strategy, but let's just hope we don't have another, terrible pandemic like this. I'm going to talk more about the pandemic here soon, but reality of the fact is there's going to be bad things that happen, recessions happen, other terrible things, and markets are resilient. And more often than not, those pullbacks are really good buying opportunities for longer term investors. Let's go to the next chart. That's what we have here. Bye-bye. Comparing outbreaks. I love using quotes. Mark Twain. I think Mark Twain gets credit for a bunch of quotes. I don't even think he did half of them, but he gets credit. Mark Twain said, "History doesn't repeat, but it rhymes." Now listen to this for a minute. 1918, pandemic of 1918, came on the heels of World War I, where 15 million people died. Stock market goes down 33%, 50 million global deaths. Fast forward 50 years, pandemic of 1968. Stock market goes down 36%, a million deaths globally. Fast forward 50 more years to where we are right now, COVID-19, stock market goes down 34%. We know the hundreds of thousands of deaths around the globe continue. I think just yesterday we hit a number of new highs in new cases in COVID-19. The really positive part of that, though, we're seeing record testing. We're seeing less and less people, at least in the U.S., less and less people in multi-month lows, people in hospitals, people using ventilators, some of those things. So there are some positives, no question about it. New York, virtually, I wouldn't say beat COVID-19, but, they've had some really good news. And last week they had the first day since late March where no one passed away from COVID-19. But what I'm getting at back on the screen here, every 50 years, Mark Twain said, "History doesn't repeat, but it rhymes." Stock market pulls back, mid 30%, terrible pandemic, and that's the lows, and then market keeps going higher. And sure enough, it's amazing that it's playing out once again, but potentially it is. So just be aware of that. One other one that's, I'll make this kind of quick, because I know, looking at the clock here, I want to make sure I get a lot of information out for you. If you look at previous bull markets, the bull market from 1950 to 1966 was a tremendous bull market. The bull market from 1980 to 2000 was a tremendous bull market. People say the bull market from 82 to 2000. I would disagree. The S&P made new highs in 1980. To me, that's kind of probably a good time to say the new bull market started. What I'm getting at, if you look from 1950 to 1966, tremendous gains in the stock market. Year 7, 1957, what happened? Recession, stock market pulls back 21%. 1980, you add 7 to that one, you get what? 87. Big time correction, scary time. Yet that was just a reset to the massive gains and then continued gains for years. Well, in my personal opinion, this bull market started in 2013. That is, I know everyone says March 2009. 2013 is when we broke out the new highs, confirming the new bull market. 7 years later, from 2013, you add 7, you get 2020. And sure enough, we've had the volatility, we've had the scary correction, the terrible pandemic. And if history is a guide to show us kind of where to go, if we look at those previous 2 major secular bull markets, year 7 was a lot of trouble, but there were years and years left of gains. And believe me, it's not going to go straight up. There's going to be pullbacks, and there might be another bear market. But just be aware of kind of what history has told us. Now, let's go to the next chart, please. The Road to Recovery Playbook is something we came together out of the LPL research, a couple months ago when all of this was bad, saying, when do we know it's safe to dip our toe in? And fortunately, a lot of these checkmarked months ago. And we said, it's potentially much safer now to dip your toe in. And sure enough, markets have done very, very well since then. So it's worked out well. We're just going to touch on these. Let's go to the next chart, please. Next slide, which is confidence in a peak in COVID-19. Now, we have definitely seen a little bit of a perk up. If you look, North Carolina, Arizona, Texas, some of those states that were the first to open that didn't really have the bad breakouts initially are starting to pick up. Some of the places in the Northeast are definitely that had it first, specifically New York City, are starting to open up. I mean, New York started to open up yesterday, right? I think yesterday was the first day they started to open up. And, the reality, though, is, like I said, on the screen here is the blue, and that's tests per day. Now, this was a couple weeks ago. We just had 500,000 tests 2 days in a row, okay? It's exponential, the number of testing that we are seeing. The way this is going to work, we're going to beat this, not by the Fed, not by the government. It's by social distancing and our doctors. That's how we're going to beat this thing. And more testing is one of the best ways to do it. And we are seeing more and more testing. That green line, it's kind of going down and to the right, I guess it was 7.8%. That's how many overall tests come back positive. Guys, it's like 4% now. So we're doing 500,000 tests, and only 4% of them are coming back positive. Those are some good signs. You think about, why is the market up so much? I mean, there's a couple different reasons. I mean, the market's up so much because the economy's starting to open back up, and there's optimism over a vaccine for COVID-19. Now, think about this for a second. There are 140 preclinical trial vaccines right now. There are 10 human clinical trial vaccines right now. My math is right. That's like 150. Wayne Gretzky, famous hockey player, said, you miss all the shots you don't take. Guys, we've got a lot of shots as it comes, no pun intended, as it comes from all these vaccines. The chances that 1, 2, 3, 4 of them hit are pretty good. I mean, Dr. Fauci said that so much just last week. So that's, again, I'm no scientist or doctor. A joke, I play one on TV sometimes, but the reality is there's a lot there. And the neat thing about it is I've read about it. Some of these drug companies are pure biotechs. They're going for real specific ways to beat COVID-19. It's kind of a high risk, high reward. Then you got companies like Pfizer on the other side doing the more traditional. So some of these newer companies could have a vaccine, by September, maybe by October. But the Pfizer is going for the more tried and true way to get a vaccine that they know will in all likelihood work. It just might take about a year or so. So we've got two different kind of a pronged approach to this. And that's, again, part of the reason, again, the market's doing so very well. Let's go to the next chart. I won't spend as much time on the rest of them. That's just kind of interesting stuff. The economy in a recession, when we first started talking about our playbook, we said we wanted to see a recession. Hey, we might be out of the recession right now. The market's making new highs. That's saying one thing. 2.5 million jobs created last month is saying another. It might have just been a 2-month, 3-month recession. But that's jobless claims, okay? We had the record huge jobless claim spike. 7 million people filed for unemployment the third week of March. That might sound familiar because that's also exactly when the stock market bottomed. Sure enough, we took a look. When you have the last 5 cycles, the spike in initial claims, the max spikes, when the most people file for unemployment, it's the darkest it can be. Yes, it's true. The stock market tends to bottom a couple of weeks before or after. And this cycle was no different. We had the record spike in late March, right when March 23rd lows hit, and now the market's taken off. It's really unique how these things tend to play out time and time again. We started talking about that in the middle of April, saying, wow, that was probably the record initial claims. Initial claims have gone down 9 weeks in a row, which is a good thing, obviously. Less and less people filing for unemployment. But it also, when that low hit with the equity market, that was the peak, and that was a good warning sign that, hey, there could be a major low here. As dark and as terrible as the headlines are, there could be some positives. So in a recession is actually a positive thing from a market point of view because it knows stimulus is coming and all the different things that can come from the government and the Fed. Let's go to the next one, please. So you want things to be cheaper. I mean, this is kind of straightforward and simple. I mean, when you look at what just happened with the 34% correction, PE multiples got cheap, right? Stocks got cheap. And when you get to a major low, that's just one piece of the puzzle, one piece of the pie that suggests that, yes, a major low very well could be in play. What we're just showing here is how PE multiples, where they started to where they were on March 23rd, got much cheaper, down 33%, which is right in line with what we've seen before at previous major market lows. And that's a check mark on signal 3 of our playbook. Let's go to number 4, please. Be greedy when others are fearful. Famous quote by Warren Buffett, another one. Once a decade, storm clouds will come and it will rain gold. Get your buckets ready when it does. Love that Warren Buffett quote. I think he did that in like the 2007 or 2008 shareholder meeting. Anyway, so it's a great one. This is what we see here, Fear and Greed Index. This is the CNN Fear and Greed Index, and it's a proprietary indicator, but we saw about as much fear on March 23rd and third week of March as you possibly have ever seen in the history of the stock market. And again, it makes sense. A terrible pandemic was coming, or was there and was coming, and stocks were really, really feeling the pain. There's a lot of ways to look at market sentiment, but what we were seeing was over the top, end of the world scenarios. And if the asteroid avoids the Earth once again, it could be an opportunity. So these are things that we were talking about every single day with our advisors and on lplresearch.com. This was a check mark for a plus, right? All that fear we were seeing in the middle and third week of March, we actually gained a plus sign, saying that's a part of the puzzle for major market lows. Let's go to the next slide, please. Sentiment. So that was sentiment. That was the sentiment part of things. And, actually, Ward, you said talk a little bit about sentiment. So I traded options for 11 years at Schaefer's Investment Research, and using market sentiment was a big part of kind of how I looked at the world. So I'm a little bit different than some other market strategists in that regard. And, the most uncomfortable you can be sometimes can plan out to be your best trades. At LPL Research, we upped our equity allocation. And we wrote about this in weekly market commentaries and talked about it in podcasts, different places. I think it was March 29th or 30th, the last week of March. We upped our equity target. Our equity allocation. We were equal weight, and we raised it to overweight. And we were equal weight for a year heading into that. And all these different check marks, these things I'm talking about right here are why we did that. Now, looking back, wish I would have known we're going to have the rally we did, but we really thought that we were close to a major low and there could be a rally. But that over-the-top sentiment is one thing. Now, right now, here and now, I look at things like what small speculators are doing and put to call ratios and money flows and some of the things like that. Near term, believe me, people are getting pretty excited, right? Stocks have done awesome. Let me get a drink just 1 second here. Stocks have done awesome. So that could mean, hey, maybe it's time for a well-deserved correction. We looked at all the major bear markets going back 50 years. After that initial surge, you get about a 9 to 10% correction on average. And after a 40-something% rally, 10% will be pretty scary. If we get a 10% correction this summer, it's going to feel scary. But you put it in context, after a 40% rally, it would be probably perfectly normal. Now, what we have on the screen right now is just another way of looking at market technicals. And this is keep it simple. We're about as oversold as we've ever been, right? There's so many stocks were historically oversold. You had the 87 crash, you had 2009 in there, and March 2020. Those were some major times, again, where we saw stocks as oversold as they were just recently. And again, that's another check mark for why we upped our overall equity allocation in late March. Let's go to the next one, which, let's see, what is it? Or can you go? There we go. Thank you. Policy response. I love this quote by Lou Holtz. I don't really like Lou Holtz. I don't really like Notre Dame, but nonetheless, I love the quote. He said, 10% of life is what happens to you. The other 90% is how you respond to it. Remember when I said LPL Research came into this year expecting a continuation of the bull market, a continuation of the economic cycle? Well, that was the 10%. How we respond to it, because what happened, is the other 90%. What the Fed has done, what the government have done, in our opinion, we're not saying we totally agree with it. We're not saying, massive deficits and massive spending and the Fed increased the balance sheet are just these perfect things that we should do. But in the situation that we were in, we really think it was necessary. And what we're showing here is just a percent of GDP. Again, GDP is your economy. The blue is the financial crisis. The orange is right now. On the left, that's fiscal policy. Massive fiscal policy in play with some of the fiscal plans that we just had. We're likely going to have our 5th fiscal plan come out probably in August. It looks like that'll help state municipalities. And then you can see on the right what the Fed has done. Keeping it real simple. Some of the numbers right now suggest about 30% of GDP has been stimulated, whether it be from fiscal or monetary policy. Think about 30% of something. That's about 3 or 4 months, right? The Fed and the government have bought us a 3 or 4 month bridge to the other side. And that's about what we shut down, right? Now we're starting to open up again. And that's to help those people that have been so very, very impacted by that. But, one of the top questions I get is, well, what about the Fed, right? They're just printing money. The government, there's so much debt out there. I can't disagree with any of it. I mean, really, I don't. And you think about the Fed also, the president gets to pick who's in charge of the Fed. It doesn't mean the president gets to run the Fed, but they pick who's in charge. Why can't we, the people, vote on the Fed? Why can't the Fed be audited? I get all these things. I'm agreeing with you. And I get that question every time I present. But the reality is the Fed does two things. At least right now it's done two things. Create confidence and liquidity. The Fed on March 23rd said they're going to start buying junk bonds. A little bit later, they said they're going to start buying junk bond ETFs. That's crazy. I never would have thought I'd say that in my life, but it's where we are. And again, it had to happen when you shut down half the economy. And that's another part. One of the bold policy response in our playbook. We checkmarked that off in late March. And again, that's why we upgraded our views on equity in late March. Let's go to the next slide. I'll try and wrap this up here in 5 or 10 minutes, and we'll do some Q&A. Estimates of collapse, not surprising. Earnings estimates of absolute collapse, one of the largest collapses we've ever seen in the month of April. Now, the good news, that's that blue line going down, how many earnings per share. That started to actually trickle higher the last couple of weeks. That's a positive sign. I know, we're off the mat. But again, earnings estimates out of 12 months have actually started to increase a little bit. Again, a further confirmation is a little more confidence coming in. We just had a record number of S&P 500 companies not even give guidance. They said, you know what? Forget it. We don't know because what's going on with COVID-19, it's so uncertain. China, our good friends from China, just said that they are not going to have a GDP target anymore. I mean, China's had a GDP target every year, and take a wild guess what happens. Throw the dart right at it. China's been nailing their GDP year after year. Now, again, we're always a little skeptical out of Chinese data. But the truth of the matter is even China is not even going to give their fudged GDP number anymore because that's how uncertain things are right now. But what we are certain of is that these earnings are started at the bottom and started to go higher, which is a positive sign. Let's go to the next chart. So this is just another way of showing earnings. This is quarter over quarter. The second quarter, that's on the right under estimates, that's going to be the biggest drop in earnings we've seen in a long, long time. GDP is going to, I think, be down 35% or so on an annualized basis, which is just, again, unbelievable in the second quarter. The good news, and again, what the stock market is sniffing out, third and fourth quarter, things are going to improve. Earnings this year expect to be down, we'll call it 20 to 25%. They're expected to be up almost 30% next year on S&P 500. And again, that's why the stock market is higher, because it sniffs out that future growth. Let's go to the next slide, please. Here we go. That's a fun one. So here we have a duck. Now go to the next slide. But look at this. If you turn it, you have a rabbit. Now, what does this tell us? This is a playful little thing, but I told you it's a duck, so you saw a duck, but you probably missed the fact there's a rabbit there. Sometimes in life, we see things that we want to see, but all you got to do is turn it around to get a different view on what's really there. And trust me, this happens to everybody all the time. So let's go to the next slide and take a different look at this. This is markets. This guy's making so much money with the S&P 5% from highs and NASDAQ all-time highs. The money's just flying out of his suitcase. Super happy. Go to the next slide, though. Turn this on its nose. That's the economy. Guys, I've done this for 22 years. I've read a lot of history, work with guys who've done this for a long time also. We've never seen anything like what we've seen the last couple months. And what do I mean by that? The disconnect between the economy and the stock market is as wide as it's ever been, right? I mean, I know we all know people who've been impacted by whether it be job loss or shutting down businesses. And then the flip side is, well, if you had a 401k and you didn't do anything, you just kept kind of putting money in every 2 weeks. It was actually I hate to use the word wonderful, but it was a really nice opportunity from an investment point of view. What's happening to the economy is just devastating. My father-in-law in Cincinnati has a restaurant. He had about 200 people a night coming into his restaurant, call it the middle of February. And then everything happened. He shut his restaurant down. The government shut his restaurant down. I mean, he had to lay off people. And I get this is real world stuff when you're talking to people. And I talked to him like, well, but the stock market's at all-time highs or improving. That says a better economy. You don't care, right? When you're busy, afraid you're going to lose your business, you don't want to hear what the stock market says. I mean, that doesn't make you warm and fuzzy. But so I've never seen a disconnect like this, and it's just unbelievable. But let's go to the next slide and try to put something to this. The stock market leads the economy. What we show here is on the right, really the part that matters. These are all the recessions. And what did the market do? How far ahead of the end of a recession did the stock market bottom? Guys, we have found the stock market bottoms on average 5 months before a recession's over. Let's just look at the most recent one, March 9th, 2009. That date probably rings a bell with a few of you. That's the day the S&P 500 bottomed and took off for over 10 years. The economy didn't get out of a recession until July of that year. So we were in the midst of a really vicious recession in April and May and June still. Then things turned around that summer and obviously off to the races from there. But that's a good way to put it. And we had, once again, the stock market bottomed in March. We think, we're 2 or 3 months away from probably the end of the recession. Again, if you look at the end of the bear market that we just had. So that's one way to look at it. And again, the 6 months is the longest recession we've ever had. This one very well might be 2 or 3 months when it's all said and done. And I know that sounds unbelievable, but it's just kind of what we're seeing with some of the economic data we expect to see coming forward the next couple of months as things really start to improve. 5 months off of March, if my math is right, that's August. We very well could be out of the recession by August. We think it'd be a tad earlier than that, but that's kind of where things play out in our view. Now, let's go to the next slide. What am I doing here? I've probably gone too long. I'll try to make this quick here. What are we worried about? I mentioned market sentiment, right? We had a great rally. We've been bullish. We're good with the rally. We do think it's a little long in the tooth near term. Summer correction be perfectly normal. There's something called sell and May go away. May to October on the bottom. For whatever reason, those 6 months are the worst 6 months. I think for the last couple of years, we have had some summertime hiccups. So we wouldn't be shocked at all, again, if that took place. So just be aware that that could be in the cards, sometime this summer before another eventual move higher is where we really do think we are. But still, the calendar is not doing anyone any favors right now. Let's go to the next slide. This is just a big picture one for you long-term investors. Stocks usually go up. It's easy to say. It's a lot harder when it's March 23rd. But look at the one under 20 years. Stocks are up 96% of the time every 20 years. If you buy and hold 20 years later, you're up 96% of the time. On a total return basis, including dividends, up 100%. Okay, so if you have a long-term horizon, yes, if you buy at 1929, 1987, 2000, 2007, I just listed some major market peaks. If you buy then, yes, that's unfortunate. But the reality is also if you buy when things are off, they say the stock market's the only place where people run out of the store screaming when things go on sale. There's some truth to that. And when things go on sale, work with Ward, work with the team before you make any major investment decisions. But when things go on sale and there's scary pullbacks, this chart is a good one to remember. If you have a long enough time frame, you're probably gonna make your money back and then some. Got only a few more charts. Let's go to the next one. People say all the time, what's your favorite chart? Go ahead and show them. The next chart is my favorite chart. Pie I've eaten, pie I've not eaten yet. There's still a lot of pie to eat in my opinion. So a couple more. Next slide is annual returns are rare. Big annual returns are rare. What's amazing to me, 2008, you can go to the left there, 2008, 2002, then 73, 74. The only time stock market dropped 15%. Look on the right, tons of years gained 15, 25, more than 25%. Believe me, you can have a big down year. There's no question about it. But it was rare. We started sharing this, a couple months ago saying, the odds of having a really big down year, it could happen. But we'd expect, getting more in that yellowish range before all said and done. And that's kind of where we still are right now. Again, we think we could have a little correction here summertime after a 40% bounce, perfectly normal. But in the end, we could finish flat, maybe up 5% or so, maybe even down 5%, but somewhere in this range, which is fine. We were down 30% for the year on March 23rd. So that'd be one of the biggest reversals we've ever seen in the history of the stock market. And just remember that. And if we finish down this year, which could happen, 7 more months, a lot of things can happen. If you're down, the next year is rarely ever down again. Yes, 73, 74, terrible recession. Yes, after the bubble burst in 2000, 2001, 2002, that's it, okay? When stocks are down 1 year, they usually tend to do pretty well that next year. If you're down a lot, that's when you maybe get in a little trouble, but we're not down a lot anymore. So if we're down this year, don't be super discouraged. Just be aware that markets would tend to do a little bit better that next year. Now, let's see what we have next. We're about done. Yeah, we're there. So when I talk about the president, that's usually when I say we're done, because then I get everybody mad and I leave. It's an election year. Can the economy predict the president? Maybe. Here's the way we look at it. If there's a recession before the election, 2 years before, or not a recession, okay? If there's a recession, the incoming president tends to lose. If there's not a recession, the incoming president tends to win. It's worked every single time since Calvin Coolidge in 1924. There was a recession about 2 years before 1924. Then the economy really got going before the election, and Calvin Coolidge won, even though there was a recession. Brings us to right now. Well, we had a recession. Does that mean President Trump has to lose? Maybe. But the economy, in our view, really could be turning around here by the time we go vote, right? Stocks are up at new highs. Again, what I've been saying for the last 45 minutes? It could be saying the economy could do a lot better the second half of this year. So it's a really unique situation. We're going to talk about it a lot more in our mid-year outlook, which we're working on. We're going to release that in about a month or so. And as we get closer, it's kind of crazy because it's an election year yet. We haven't really talked about it much, rightfully so, with all the other things going on. But as we get closer, we're going to talk a lot more about that. So just be aware that the economy very well could predict the next president. How the economy's doing heading into the election sometimes can weigh on people's psyche as they're voting for their next president. Let's go to the next slide. I think I'm done, I think. Yeah, okay, good. So that is the last slide. I went a little long, as I usually do, because I just talk so much. But yeah, Ward or Michelle or somebody jump back on and let's do some Q&A. But thank you so much for having me. This was fun.
All right, Ryan, sounds good. Well, thank you so very, very much. And if anybody else, if anybody out there has, per se, gotten a little sleepy or whatever, feel free to get yourself some coffee. But whatever you do, please don't give any coffee to Ryan. So
I don't drink coffee, actually. I don't. I get up and go.
Well, Ryan, we appreciate your enthusiasm. We appreciate your energy and certainly the wealth of knowledge that you are. And of course, the team here at Covenant Wealth Strategies and our own internal investment research committee, we've benefited greatly from the research that LPL puts out. So we thank you for that. We do have a number of questions that have come in. And we'll see how many of these we can get to, but feel free to email your questions to Michelle at covenantwealthstrategies.com. So Ryan, a couple of questions. First of all, can you comment on trends to invest in going forward as we evolve into the, quote, new normal? So what are we looking at in terms of where are the opportunities going forward?
Yeah, great question. Sometimes it's the opportunities, but maybe even more importantly, are kind of where we should avoid. I'll start with that. Think about the tech bubble, right? The tech bubble. What group did poorly for the next 10 years? Technology. Technology lagged the next 10 years. Financial crisis took place. What group lagged over the next decade or so? Financials. So you think about that, the leaders, the laggards that got in trouble and whatever that crisis was were the ones that didn't do quite as well. You fast forward to right now, cruise lines, airlines. I mean, some of these areas that have really been hit hard. If history kind of replays itself, I mean, there can be some wonderful opportunities here. Don't get me wrong, but those could be some areas that maybe after this initial bounce here might lag as we go out several years. What does LPL research like right here and now? Well, we have liked large caps over small caps for a while. We continue to be that way. Small caps have done really well the last couple of weeks. Value has done really well the last couple of weeks. Cyclicals have done really well the last couple of weeks. Those are some areas, though, that have lagged a long time. We still like technology. We still like healthcare a lot. We do like financials and industrials, that more cyclical play. But we still kind of stick with healthcare and technology as two of the groups have led for a while. They've lagged a little bit lately, but look at today. Today they were leading today, and the market sold off a little bit. So those are some areas we like. And you think about the NASDAQ. NASDAQ made all-time highs yesterday, but NASDAQ has lagged the last couple of weeks. It's still at all-time highs. I mean, it's still participating in this rally. So again, our view there is kind of stick with who got you to the dance, so to speak. One of the popular questions we get, I've been here 4 years. I make the joke, people love talking about marijuana stocks. I'm very limited to what I'm allowed to say on marijuana stocks or Bitcoin. I'm limited to what I can say on cryptocurrencies. But the other question I get a lot of is, what do you think of Europe? Europe has lied to the U.S. for 20 years. Developed markets have. What do you think there? And we've had some internal discussions. We haven't liked Europe for a while, and that's worked out well. If you talk about other developed international companies or countries, Japan is the one area of the world. We like the U.S., but Japan is really starting to improve a lot. I showed that chart, 40% of fiscal policy going in. I mean, they're doing some things that they're trying to revive their economy, get back some inflation. So Japan's another area that we absolutely have warmed to. And lastly, to put a bow on it, emerging markets. We do like emerging markets more than Europe. But specifically talk about emerging markets, we're looking at Asia, right? Asia, some of those parts of Asia will be like the places in South America and Central America. Those emerging markets where it happened with COVID-19 are the areas that we're still a little concerned with what's happening. I mean, China again, do you trust Chinese data? I get it. I mean, no one really does. But there's been some positive trends coming out of China, out of South Korea, and out of Japan as they got hit with everything first, and they're starting to come more forward. I'm aware Japan's not an emerging market. I'm just saying that part of the world is definitely improving. So that's kind of how we have a lot of our models positioned here at LPL Research.
So a follow-up question for me on this, there's this concept of a rotation, where things that were in favor kind of rotate and go out of favor, and those things that were out of favor rotate and become in favor. And it does seem over the course of the last month, up until today, that there was a rotation, right? So you talk about travel and leisure stocks, whether it's airlines, whether it's cruise operators, whether it's hotels, they seem to have really rotated into favor over the course of the past month. Maybe that's because they had fallen so precipitously over the prior 2 months, but up until today, and it seems as though then today the rotation rotated back, and again it was large cap and it was tech, and those travel and leisure stocks got creamed again today. So can you talk a little bit about this concept of rotation in favor, out of favor?
Yes, and that's kind of along the lines of market technicals. There's an old saying, rotation is the lifeblood to a bull market, because the same groups aren't just going to lead all the time. I mean, that's not how bull markets work. If the same groups lead, you want them to pass that baton around. I mean, again, what we just saw with healthcare and tech leading until, we'll say, a couple weeks ago, they passed the baton to financials, industrials, materials, like you said, some of the travel and leisure. I wouldn't say they really passed the baton to those because they're so beaten up, but those groups really, really did well. So that's a good thing. I mean, they're getting a little geeky. I know you like technicals. The advanced decline line is how many stocks going up versus down. And when that's making new highs or getting close to new highs, that says, hey, there's a lot of broad-based participation. That's what we're seeing. We are seeing broad-based participation in the market. And again, that's kind of the leaders and laggards that are kind of taking turns here. But Jeff Bookbinder, a strategist on our team, also, I did a study just recently for our team. We talked about it. Jeff did most of the work. I guess I took the credit. But when we took a look at growth versus value, and again, growth has led value for a long time, right? Easily 10 years. We've seen pockets between 4 to 6 weeks where value does really, really well relative to growth. And then you know what happens? It kind of goes right back to growth. And our personal opinion at LPL Research, we're tilted a little bit toward growth here, not by a lot, but we are tilted a little bit toward growth. And we're using this almost as an opportunity here in some of our models. We're actively talking about maybe adding a little bit more growth relative to value on this really historic swing that we've seen the last few weeks. As we think, last thing on this, I think it's interesting. What does well when you have low growth? Surprisingly enough, is growth stocks, because investors are reaching. They're grabbing for growth when there's not a lot of growth. When you have high growth, value does better. Remember I said for 10 years we couldn't even print 3% GDP? What did well for 10 years? It was really growth over value. Yes, we're having a big growth coming in the second half of this year relative to the lows we were just at. But by no means, the World Bank came out and said, I think U.S. GDP down 6% this year. We think that makes a little bit of sense. Even next year, GDP might bounce back only 3 to 4% after a 6% drop. We're still in a low growth world. And it's not that we don't like value and you can't find some opportunities there, but we still think, a name like healthcare and tech are the two areas we like. And healthcare, my goodness gracious, people are getting older, all the stuff that's going on with COVID-19. There's a lot of money coming in, and it's election year, so there can be some, we're going to give more money to healthcare now to get ready for the next potential, calamity or pandemic that might come. So those are groups that we still think are going to benefit longer term when all is said and done.
So we have another question here, which just kind of follows right onto that, Ryan, is you're talking about, if you will, technology, which especially kind of with this work from home, and I've heard it said that the next 5 to 10 years worth of innovation basically has happened in the last 90 days. So there were certain trends that were out there, like work from home was a trend, or certain, even in healthcare, just with things being accelerated in terms of cutting through the red tape and trying to get some things fast tracked. So technology, healthcare, can you talk a little bit about consumer discretionary, and specifically the question that came in is commenting on the financial health of the consumer pre-COVID and how that could impact economic growth post-COVID. So here at Covenant, we liked the consumer pre-COVID, And we're curious as to your thoughts about how this whole situation has impacted the consumer going forward. Should we still like it as much, like it more, like it not so much?
Yeah, well, consumer discretionary, we're market weight, so it's kind of right down the middle. I'm not giving you a solid answer one way or the other, but it's not we don't like that group here and now. But that is such a good, I can take this answer probably 10 different ways. The truth is the consumer was in really good shape before COVID started in March, right? If you look at things, we always hear about, oh my goodness, look at all the debt that's out there. Yes, there's like record debt, okay? People have a lot of debt. What they don't tell you is the denominator. I call it denominator blindness. There's record wealth out there. So if you're worth more money, you probably will have a little bit more debt because you own more, you have more equity. And that's something that gets lost in translation. So you think about it, one of the positives to COVID, and trust me, there aren't many, but if you look at just 2 days ago, the numbers come out for overall credit card debt. Credit card debt the last 2 months has just dropped straight down, okay? People are taking it easy. They're staying inside. They might have lost their jobs. Hopefully they didn't. And they got this extra money now, and they're saving money by not going out, buying expensive stuff. People are really paying off their credit cards right now. And I was worried personally 2 months ago that credit cards would soar because people are losing their jobs and they're worried and they're trying to spend money the best that they can. So that's a real positive thing. The consumer is being smart, in my view, as to what they're doing when I see credit cards are drastically dropping the last 2 months. But going forward, it really is so tough to say because here's something that's unique. The savings rate just came in last week, but it was for the previous month. Long story short, the savings rate in the United States was 33% last month. The previous record of all time, I think it was in the early 80s, was like 12 or 13%. And again, it's not a shock. People weren't spending money, so what are they doing? They're saving money. Now, that's going to change. Things open up. People are going to start spending money again. There's no doubt about it. But think about this. I'm not saying there's a Great Depression, because I don't think there will be. One of the problems with the Great Depression, though, people saved money because they were devastated by what happened, and it changed their mindset for decades. And that's one of the reasons the Great Depression took so long, because people didn't just open back up their wallets right away, and they'd rather save, even if they maybe should have. But again, they were just, slammed into thinking what happened with the Great Depression is going to happen right again. And we do have some concerns about what just happened with COVID with the high savings rate. We need the consumer to open up. They're 2/3 of the economy, right? And if they keep saving and don't go out and spend, that doesn't mean, it means you can still have the recession over, but you're not going to have a great expansion or great expansionary growth coming right off of the lows, which is what you tend to see coming off of lows. So, yeah, long-winded answer. We still believe in the consumer, but we have some things we want to watch here with some of the data over the next couple of months.
Well, it's interesting. We're looking at, of course, there's concern about people that have lost their jobs. With the $600 a week federal unemployment insurance on top of state unemployment insurance. Yep. We understand that over half the people that have lost their jobs are actually making more through the unemployment insurance than they were, when they were working. So that's a little bit of a problem in terms of businesses trying to hire workers back. And not only has savings increased, but also obviously related, but the amount of money in people's savings and checking accounts. I think Bank of America came out and said that the balance in people's savings and checking was up nearly 30%. So to the extent that the federal government, through fiscal policy, has, and everybody, of course, most Americans got their $1,200 check, right? So you can't go out and spend. You can shop online, which speaks to technology and some of those trends. But it seems to me that most consumers, at least from a asset and liability balance sheet standpoint, are perhaps in a stronger position than they were pre-COVID. So now we just need to see what happens with reemployment, those 20 million people that get reemployed. And do you think there'll be maybe not a continuation of the $600 a week, but maybe this fifth fiscal package they're talking about, perhaps a weaning, maybe $300 a week for another 90 days or something like that? What do you see, Ryan, as it pertains to fiscal policy and additional stimulus coming down the pipe?
Yes, great points there, but we do think that, yes, that's not just going to go away, but we think it's a tough bet to think it's going to be $600 going forward. And that next fiscal plan, we think very well can be in August. Here's the truth. That 2.5 million job print we saw on Friday was great. The stock market rallied. Everybody was happy. it might have pushed back the need for that fifth stimulus plan, right? It was a terrible number. We might have had it sooner. But you bring up a really good point. I mean, a lot of people are making more money now by just staying at home than they were when they were working. Well, that is really not going to incentivize somebody to just look for a job right away. And there's talk that in this next stimulus plan, again, that we're thinking could be early August, there could be some, I guess, some tax benefits in there for people that go back to work to hopefully try to make up for that and hopefully incentivize people once things get going back and jobs are there, not to just stay, you know, just to sit around and get their checks, to go back and hopefully some carrot, I guess, at the end of the line to get them to go back to work in a tax, a little tax bump, a little money bump, I guess I should say, in that next fiscal plan. But there's no doubt about it. There will be a fifth plan. There's a lot of back and forth with Washington, and again, we wouldn't be shocked at all about that fifth fiscal plan if it talks about infrastructure spending. You know, have that in there. It's going to help municipalities, going to help states. Like I said, going to continue to help unemployment there. But we think that there could be some infrastructure in there. And the reality of the fact is this: with low interest rates, with historically low inflation, now really is a time to use more debt if you need to, and we think we need to. So it is a little bit cheaper now to do it now versus early 80s when interest rates were 15% or so. So that's just something to be aware of. And we think the government knows that, and that's probably why some infrastructure will be in this next plan as well.
So, Ryan, we recognize we're a little bit over 5 o'clock. If you have just a couple more minutes, we actually have three additional questions remaining. Can we move forward?
Yeah, I'll try to answer them quickly, and let's do it. Absolutely.
Okay. So, talking about again this next federal stimulus package, there's been conversation about how states and local municipalities are creamed, just in terms of they're not collecting payroll taxes and they're not. A lot of the economic activity that generates taxes. So municipal bonds, in light of state and municipal struggles and calls for a Fed bailout, what are your thoughts as to investment merits for municipal bonds? And what are your thoughts about if or not a federal bailout of state municipalities in the next fiscal package?
Yeah, well, I mean, we do think there's absolutely going to be as we'll call it, a fiscal bailout for states and municipalities. I mean, that likely has to happen. So that's fully expected to be in there. It's just, we've seen, $1 trillion stimulus package. Well, I guess it kind of depends on how the economy is doing, honestly, over the next month or two, which way that trillion goes, if it goes larger or goes smaller. But on the side of, municipalities here and investments, we're market weight that group. Again, when the Fed came out and said that they were going to start to buy some of that debt from municipalities and places, that really helped that backstop. And it's almost as simple as if the Fed is willing to backstop it, then it can do well. I mean, we've seen that with all different parts of debt. When the Fed says they're going to backstop the investment grade, they're going to backstop high yield, whatever it is, those groups hold up, and then the groups that they didn't say they're going to backstop were the ones that the market started selling and started hurting. Now the Fed is backstopping everything, and that gets into that whole discussion I said earlier. Is the Fed too powerful? Is the Fed too all-encompassing? I can't disagree with some of those, but the Fed is still there, and they're still a buyer, so we're more market weight that group as it pertains to fixed income.
So it almost sounds, there's a concept out there called moral hazard, which, if I can explain it correctly, says basically, you invest, and part of your investment premise is that the government will bail you out. And so back in 2007, 8, 9, with Lehman Brothers and some other things back then, in the spring, I forget which firm it was, but a firm failed in the spring. It might have been Lehman Brothers failed in the spring. And then in the fall, they basically didn't let another bank fail, but they were concerned. They didn't want to backstop everything because of moral hazard. That seems to be out the window at this point.
It really does. I think it was Bear. I think Bear went under first, I think in March, and Lehman was later that year, I think. But
anyway, so you're right. Lehman was September 16th because it was my wedding anniversary. I remember that weekend.
Happy anniversary. Yeah. Real fast, a fun one. My birthday is October 28th. If you look at every single day of the year, that's the most bullish day of the year for equities, October 28th. I'm in the right industry.
That has a lot to do with why you got into this industry. Ryan, one last question we have for you. You had mentioned one of your slides. You had mentioned, I think you said something to the effect of red and black as colors seem to foreshadow very, very bad things, or they're indicative of very, very bad things. And so a question came in about the team colors for the Bengals, and I'm not sure, but aren't the team colors of the Bengals red and black or something very, very
well, orange and black, but I would agree if you followed them for decades like I have, yeah, usually orange and black lead to bad things as well. So that's an astute observation there.
Well, maybe you should make a suggestion to the team and demonstrate with your investment prowess how orange and black and red and black are not such great ideas, but that they ought to consider changing the colors for the team.
Well, Joe Burrow looked pretty good in purple and yellow with LSU. So maybe we should just go LSU colors, let them feel at home.
Well, Ryan, we just want to say thank you so very, very much for coming and spending part of your Tuesday afternoon with us. I think that our clients got a very thorough taste of the quality and an abundance of thoughtful information that comes from the LPL research team. And one other reason why we are fortunate and thankful to be able to have LPL as our key stakeholder, key strategic partner. So I just want to say thank you so very, very much, and ask if you have any closing remarks before we wind up wrapping it up.
No, yeah, I'll just say this. I get to do, a good handful of these, and I can tell you guys, you're very, very lucky. Ward and the team are doing these, reaching out to us, trying to leverage us. It's scary what just happened. There's no doubt about it. I'm a market professional, whatever you want to call me, but it was scary in March. But, know that you are in just really, really good hands. And I know Ward and the team are an email or a call away. You can get a hold of me through Ward if you need something. I'd love to help. But just know that we're going to have more corrections. We're going to have more volatility. It's going to be more scary things that happen. We're going to have more recessions over the course of, the next, 10, 20 years. But just keep listening to Ward and the team and what they're doing for you, reaching out to us and doing different things like this is awesome. And I'm honored to be part of it, a small part of it. And I'll continue to help any way I can. So thank you, Ward, for having me, my friend.
Ryan, thanks very much. It has been said that the two directions of the market are not up and way up. So that is to say that the markets do go up and down. That's part of their function. Sometimes it's an escalator up and an elevator down experience, but that also speaks to the importance of having a diversified portfolio and making sure that you are managing risk appropriately and don't put all your eggs in one basket. So there are some good, solid, time-tested premises that we incorporate into our portfolios. And we appreciate, again, the opportunity to partner with LPL. So for those of you on the call, thank you again for joining us. Thanks for your participation. And for those who send in questions, we thank you for those. If you have additional questions, please feel free to email Michelle at Covenant Wealth Strategies, and we'll gladly get those questions answered for you. And again, I want to thank Michelle and the team here at Covenant for the great job that they did putting this virtual program together. We will have an email that will go out in the next several days. When you are here in person, you know that your ticket out of the building is your feedback form. And so since you're not in the building, we can't do that, but we will be sending out an email in the next couple of days with some feedback, with the feedback form. We would greatly appreciate that as well. We also have an objective to have this video presentation available. So if there are others that you know who you think would benefit by listening, again, please email Michelle at Covenant Wealth Strategies, and we will make sure that you get a link to this presentation that you can then share with others. Of course, if there are people that you know that you think would benefit from a conversation with our team here at Covenant, we are accepting a limited number of new clients this year. So thanks to everybody, and stay healthy, stay well. God bless. Bye-bye.
Bye-bye. Thank you.